The stock market has been doing a lot of this. I mean, we saw the stock market recently break new highs, and we're still in a pandemic, and people are still worried about the health of our economy, which is why you have people talking about a potential stock market bubble and wondering if the stock market bubble is going to burst. So if you want to know what's going on in the stock market, make sure you watch this video until the end. What's up, everybody? I'm Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. Lots of people are worried about the stock market because we're still in a rough economy. We still have millions of Americans out of a job. We still have all the stimulus stimulating the economy, and yet the stock market has been rallying. Couple that with the fact that now we have so many people entering the stock market as new retail traders, meaning new regular people trading their money in the stock market, and many of these people are trading on margin, meaning with debt. That's why we have the highest margin trading now than ever before. And so people are worried that this could be potentially inflating the stock market into dangerous levels. I mean, some days it really feels like the stock market is more of a casino than it is an investment tool. I'm not a gambler. I'm also not a trader. Now, you can make a lot of money trading, but that's not for me. I am an investor. I like to invest my money for the long term, but I like what Warren Buffett has to say about that, because Warren Buffett says that in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. That means in the short term, you could see wild swings in the stock market because people will be trading and buying up the next hot stock. But over the long term, that's where the strong companies are going to win, because these are the heavy companies. These are the big companies that actually have the ability to survive over the long term, not just through the popularity contest. Now, if you really want to understand what's going on in the stock market and get a better sense of if the stock market is going to sell off, there's a few things that you want to understand as of right now. Now, this can change over time, but right now, a few factors that you want to pay attention to are inflation, the stimulus, and how this is affecting the economy and the economy. This is things like the unemployment rate and interest rates. These are the three things that I'm going to be talking about in this video. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. And a quick word from our sponsor, M1 Finance. If you are interested in investing your money into the stock market for the long term, M1 Finance lets you do it automatically and passively. So if you want to learn more and see how you can automatically and passively invest your money into stocks or ETFs, I got the link to where you can do that with M1 Finance in the description below. So let's start by talking about inflation, because inflation is a very hot topic, especially with all the money printing going on. But I think a lot of people don't really have a very good grasp of what's really going on, because in the beginning, we weren't worried about inflation. It was deflation, but this might be turning around. I'll show you what I mean. So we live in a credit-based society. What that means is when you go out and you go shopping, you can buy things with cash, with actual money that you have earned, or with credit, which is debt. And in the marketplace, there's no difference between credit and cash. If you go to the restaurant and you spend $100, the restaurant owner doesn't really care if this $100 is coming from money in your bank account or if this $100 is coming from your credit card. So in the marketplace, it doesn't matter if you're spending credit or cash. It's all the same in the marketplace because no one knows the difference. And so when we're in a credit-based society, the more credit that there is in the economy, the more debt there is, the more money people have to spend, and the more the economy can grow, because our economy runs on spending. When you make money, now you have more money that you can spend, you have more money that you can use to rent an apartment, you have more money that you can use to buy a car, you have more money that you can use to eat at a restaurant and spend money at the mall. So the more money that you have, the more money that you can spend. Now, because we're in a credit-based society, we don't live in a system where when you make $100, you can only spend $100. Now, because we're in a credit-based society, if you make $100, you can spend $200 thanks to the help of credit, debt. You can get a loan or use a credit card. And so when we're in a credit-based society, people have the ability to spend more money thanks to the help of, well, credit. And so what happened when this 2020 pandemic and recession hit is many people lost their jobs. And when you lose your jobs, you lose your income, which means there's less cash in the economy because people stop making money. When people stop making money, they have less money to spend. So not only did we see cash go down in people's hands, but we also started to see credit disappear. Because when people don't have an income, you are no longer credit worthy. And so when people are not credit worthy, now all of a sudden, our economic system has just lost so much money, because not only are people not making money, but credit, which is actually the biggest part of our economic system, was disappearing because people are no longer credit worthy. And so this is just the system that we're in. I'm not saying this is right or wrong. This is just how it works. People spend their money not based off of how much money they have, but based off of how much credit they can qualify for. So when this pandemic hit, the Federal Reserve Bank started printing all this money and we saw these stimulus checks go out and everybody was talking about inflation. But the real issue then was not inflation. It was deflation, because we saw money leaving our economic system because credit was disappearing. Because remember, cash and credit are the exact same in the marketplace. And so when credit started to disappear, there was less dollars in circulation because we didn't have as much credit out there. And so all this money that was being printed, so we had more cash being printed by the Federal Reserve Bank, and this was being injected into the economy by the government. We had more cash being printed to balance off this lack of credit. So in the beginning, we were working to fight deflation because we didn't have enough credit in the system. But now things are starting to turn around. Now, just so we're all on the same page, inflation is when the value of your dollars, the value of your savings, the value of your earnings, is when the value of your dollars go down. So when you see the government fund new stimulus programs, they send out stimulus checks where they fund bailouts. The government doesn't have the money just sitting in a vault somewhere to fund these stimulus programs. So in order to fund these stimulus programs, this money has to be printed. So the Federal Reserve Bank prints this money, they give it to the government, and the government puts this money into the economy. Now, as that money is printed, inflation happens because as more and more dollars are created, the value of each dollar that you have goes down. And what happens when your dollars become weaker is the price of things go up. That's why your rent keeps getting more expensive. That's why your groceries keep getting more expensive. That's why vacations keep becoming more expensive. And that's part of the reason why homes become more expensive over time is because of inflation. As the value of your dollars get diluted through all this money printing, the value of your dollars go down and the price of things go up. And now what we're seeing happen is in the beginning, remember we were worried about deflation, but now things are starting to turn around. Credit Suisse said that deflation is starting to go away and we're starting to see more inflation. Now, if I had to guess what's going on, that means that we have more people that are getting jobs. So more people are starting to get their cash, which means more people are becoming credit worthy, which means credit is coming back to life. This thing that was kind of empty before because of the pandemic and the recession was empty. Now this credit system is coming back to life. So there's more credit in the economy and cash is also coming back. But there's also this brand new injection of cash because the Federal Reserve Bank and the government printed trillions and trillions of dollars during the 2020 and 2021 recession. And so we have this brand new influx of cash. We have more people getting their jobs back, which is more cash here, and we also have credit recovering. So now we have way more dollars in our economic system, which means our dollars are becoming weaker. Our dollars are getting diluted. And that's also causing the cost of labor to go up. Like Credit Suisse in their report said that Chinese labor is starting to go up. So the cost of manufacturing goods that are being made overseas, which was supposed to be cheap, is now becoming more expensive, which means that the price of your things might be going up. Even Bank of America just released a study and they said that they're worried about inflation. They say that they're looking at things like food costs and the price of food is going up. And so people are making, in general, the same amount of money as before. Some people are making more money, some people are making the same, and some people are making less. But in general, people haven't really seen a massive increase in the amount of money they're making between 2020 and now. But the price of everything around us is starting to go up. And a lot of people predict that it's going to keep going up in the future. So what that means is when it comes to an economic recovery, if wages don't start to go up, if people don't have more money, but the cost of everything keeps going up, it could become harder for more people to afford things. Now, if people are not spending the money because they don't have money to buy things, that could slow down the economy in the future just because our economy runs on spending. Remember, when you have money, now you have more money to go out and shop. You have more money to spend at restaurants and more money to spend at the mall. And when you spend money at the restaurant, now the restaurant owner has more money to open up another restaurant and hire more employees. So spending helps our economy grow. But if people don't have money to spend, either because they don't have a job or because they don't have access to credit, well, then that can slow the economy down. But in this case, if inflation continues to go up, kind of like the way it is now. Now, I'm not saying this is going to happen. This is just what some banks are predicting and worried about. But if inflation keeps going up and people can no longer afford their same lifestyle and people have to start downsizing just because they can't afford things because of inflation, then that could slow the economy down. Now, the economy and the stock market are two separate but similar things. The stock market is not the economy, but if we have a struggling economy or economy that's not growing as fast as the stock market would like, eventually that is going to cause the stock market to come down. So this is where you have to really pay attention to wages. Because if wages continue to go up, if they start to go up a little bit faster and then meet inflation, then this is not going to be a problem. But if we don't see wages go up to meet inflation, or if we see wages stay the same, then this is going to be a problem, because we know that the cost of living is going to go up. We've seen so much money printing happen. We've seen a record amount of money printing happen actually in 2020 and 2021. So yeah, we are going to see more inflation. And if wages do not go up, this is going to be a problem. So this is something you want to pay attention to, but more on the side of wages, because we know that inflation is going to happen. How much? I don't know, but you have to compare this to wages, because if wages go up with inflation, no problem. But if wages don't go up to match inflation, now we have a problem. The second thing that you want to pay attention to understand the stock market is stimulus, because we're in an economy where millions of Americans are still out of a job. I'm going to talk more about this in number 3. But again, our economy is struggling, yet our stock market is booming. Now, to help stimulate the economy, the United States government is working to pass multi-trillion-dollar stimulus programs to help create jobs and to help get the economy going. One of those is the $1.9 trillion stimulus program that has put $1,400 checks into the hands of Americans all around the country. The whole idea behind these $1,400 checks is now you have a lot of Americans that are struggling to pay their bills. And so the government is giving Americans these free stimulus checks. I mean, it's really not free because you pay for this through your taxes, but let's just call it free to keep it simple. You get these free stimulus checks, and now you have this $1,400 that hopefully the government hopes that you're going to take this money and you're going to go out and you're going to go shopping. Because now when you go shopping, now this is going to stimulate the economy, because now businesses are going to get this money. When businesses get this money, they're going to have more money that they can use to invest in themselves, create more jobs, create new stores, create new offices, so more people have jobs, so more people have incomes, so more people have money to spend. Now look, we have the minority mindset. That's why you're watching this video. So we don't think like the majority of people. I want you to understand that it is not your patriotic duty to go broke and spend your stimulus check just for the sake of the economy. I'd rather you use your stimulus check to stimulate yourself. Use that money to build your own wealth. Invest that money to make you more money, instead of just using that money to go to the Gucci store to buy something nice because you got some free money. Because what happens when these $1,400 checks go out is you see a line at the door at Gucci. You see a line at the door at Louis Vuitton, because people got free money, and now you can go out and spend it on something nice. Instead of you using that money to stimulate the economy, I want you to use that money to stimulate yourself and your wallet. But in general, the purpose of this $1.9 trillion stimulus program is to get money into the hands of people so people have money to spend and to pay their bills. The second stimulus program that was just passed by Joe Biden and the presidential administration is the $2 trillion infrastructure program, which is supposed to more directly create jobs. I'll show you what's going on in this program. So at the time of me recording this video, this is just what's proposed. You have $621 billion going into transportation infrastructure. That means hiring people and companies to rebuild bridges and roads and public transit and ports and airport and electric vehicle development. You have another $400 billion going to care for elderly and disabled Americans. That's a lot of jobs to care for those people. You have $300 billion going to improve our drinking water. That's a lot of jobs to go into the water infrastructure in our country. We have another $300 going into building renovation, and we have another $580 billion going into American manufacturing and research and development. Now, if you made it this far in this video, you understand that there's a cost to printing free money, and we just talked about that with the inflation. But the purpose of this $2 trillion plan is really just to create jobs directly, because this $2 trillion is going directly into infrastructure. It's going directly to hire people, to hire contractors, to create agencies, to manage these contractors, to rebuild our roads, to rebuild buildings, to rebuild bridges. That way more people have jobs, and it's supposed to improve the infrastructure in the United States. All in all, what that means is we have kind of like a once-in-a-lifetime stimulus boost being given to our economy to create new jobs, to give money to people, to give money to businesses, to help our economy grow. So remember, the stock market is not the economy, but they are similar. And so, yeah, we have some struggles in the economy, but we have an insane amount of money being printed, and we have an insane amount of stimulus being created to help boost the economy, to get our economy going. Now, if we jump out of this pandemic quickly and our economy starts to recover by itself, and we also have these trillions of dollars going to boost our economy to create new jobs, well, this could create one of the most booming kind of years ever in our economy, because we've never seen money printed like this before. Now, yes, it is going to come at a cost, because we're going to have to pay this money back plus interest through this inflation. But in terms of just the economic growth of our economy in the short term, yeah, we could see a huge boost in our economy at least through 2021 because of all these new stimulus programs. Yes, there's a long-term cost to this, but in the short term, this could push a massive boost into our economy, which could really help the stock market go up even more. Remember, the stock market is a place where people go to bet their money based off of what they think is going to happen in the economy in the future. And so now, if our economy grows faster than expectations, which could happen if we have all this kind of help and support through the government, well, that can help the stock market go up even more because our economy is just going to keep growing like kind of a rocket ship. Now, before I get into number 3, I'm not going to be talking about how to actually invest your money in the stock market and how stock market investing works in this video. But if you do want to learn more about that, our team put together an amazing guide, a PDF that walks you through stock market investing and how to successfully invest your money in the stock market. You can read this PDF for free when you sign up for a newsletter. And if you want to do that, I'll put the link for you in the description below. And the third thing that you want to pay attention to understand if we're going to see a stock market sell-off is now ultimately the economy. I've been talking about this the entire video because again, the stock market and the economy are similar but different. The stock market is a place where people go to bet their money based off of what they think is going to happen in the economy. So while we saw our economy way down here, our stock market was going up here because everybody was betting their money thinking that our economy was going to recover. And yes, our economy is recovering, and now we have all these new stimulus programs being passed and being proposed to help our economy grow even more. Now the question is, where is our economy actually going? Because that's going to help indicate where our stock market is going to go, at least in the short term. The first thing that you can pay attention to really understand the economy is unemployment rates. We still have millions of Americans out of a job, but jobs are starting to come back because people are starting to get vaccinated, and people have this kind of pandemic fatigue because they just want to go out and they want to start living their lives again. I mean, it's been more than a year of this pandemic going on, and people be stuck in their homes because of restrictions and lockdowns, and people being scared to go out and eat at restaurants and go to movie theaters and hang out with their friends. But now, as kind of cases are starting to go down across the country, there are some states where cases are going up, but overall across the country, this pandemic is going down, and hopefully we're nearing the end of this pandemic. Many people are just waiting for that minute that they can start going out and they can start traveling, and they can start eating at restaurants, and they can start going to movies and bars and just kind of enjoying their life again. And because of that, we're starting to see a surge in hiring. Restaurants and bars are starting to hire more people, so people are starting to get their jobs back, which means good news for the economy because again, as people make more money, now they have more money to spend, which helps our economy get going. At the same time, we still have historically low interest rates. Now, interest rates have come up a little bit off of their highs, but over the long term, we are still at historic low interest rates. That means it is super cheap for you to go out and get a mortgage. It is super cheap for you to go out and refinance on your home. It is super cheap for businesses to go out and borrow money to have more money to invest in their business. That's very good news for our economy right now because it gives more money into the hands of people and businesses to spend. Remember, our economy runs on spending. So as people and businesses have more money, it's easier for our economy to grow, but it's a double-edged sword because we cannot keep interest rates this low forever because cheap debt doesn't have a cost. As more cheap debt is out there, it is easier for people to go out and borrow money, and you never want to be in an environment where people can borrow more money than they can actually afford. And so we're going to see interest rates go up. I mean, we've already seen interest rates go up slightly, but not much. But if interest rates start to go up more, the concern the government and the Federal Reserve Bank have is that if interest rates go up too much, then now people don't have the means to go out and buy homes anymore because homes are not as affordable. Or if people are less likely to use credit to buy things, now that could slow down the economy. Now, I don't know what's going to happen with interest rates. The Federal Reserve Bank keeps giving conflicting opinions on interest rates. On one hand, they say that they're going to keep interest rates super low, near zero, until 2024. On other days, they say that they're only going to keep it near zero for a few more months or until the end of 2021. So I have no idea what's going to happen with interest rates. But what you want to pay attention to is how fast interest rates rise. Because if interest rates start rising very quickly, then that could potentially slow down the growth of the economy. Now, will it? I don't know. But in theory, you think it would, because now people can't borrow money as cheaply. So less people are going to be buying homes, less people are going to be refinancing, and that could slow the economy down because people are not going to be spending as much money. So again, the economy and the stock market, similar but different, but if our economy is not growing as fast as the stock market would like, that could cause the stock market to go down. But if our economy is growing faster than the stock market imagines or predicts, then our stock market is going to go higher. So again, yes, the economy is a part of it. Our economy is recovering. People are getting their jobs back. Interest rates are still low. And we have all this stimulus going on. And so in the short term, yeah, we could see a huge boost in the economy. Over the long term, some things that you want to pay attention to are interest rates. How fast are interest rates going to go up? If they go up gradually, maybe we won't see a real major effect of it. And another thing you want to pay attention to is inflation. How fast are the price of things going to go up? Because if people can't afford, just basic life to go out and spend, that could slow down the economy. But at the same time, you also want to pay attention to how these stimulus programs affect jobs, because now if more high-paid jobs are created, then that could help boost the economy because people will have more money to spend. So I know this is kind of confusing because there's so many different factors that you want to pay attention to, but that's how our economy and the stock market works. It's not just one indicator that you can pay attention to where you can say, oh, this is happening, so the stock market's going to go down. That's not how it works. It's an onion with a whole lot of layers, and sometimes one layer has more weight than the other. It's impossible to predict that, and so if you want to be investing your money in the stock market, you just want to understand the risks, and you want to understand your goals, and you want to have a strategy, because if you're a long-term investor, you want to be investing for the long term and not really get bogged down by the emotion when you see short-term swings. If you're a short-term trader, you got to have your exit strategy in place, because if we see a correction, you got to know when to get out. But at the end of the day, you just gotta remember that recessions and crashes make more millionaires than any other time. And so if you see the market dip, that's a great opportunity for you to buy, but you just have to remember your strategy. If you're investing for the long term, remember to invest for the long term. If you enjoyed this video, here's a video on things you should not do when you get paid that I think you'll love. And while you're at it, download our free stock market PDF. And as always, keep hustling. This money needs to be saved as soon as possible, because if you do not have $2,000 saved up for an emergency, you are in financial danger.